You might have heard about stock options before. They are derivatives that allow you to bet on the upside or downside of an asset. You're basically betting with another person if the stock's going to go up or down. Now, crypto options are very similar in a few aspects, but in others they are different. And we're going to be taking a look on these differences. Now, your usual stock options that you might find on Robinhood, they are what are called American options. Now, an American option has two qualities, has two properties that might go in your favor or against you. The first one is that with an American type option, you can assign or get assigned before the expiration date, meaning that if you're buying this option, you can assign the seller. So before the expiration date, you can then assign the seller to do his end of the deal if it is in favor to you. Or in the case you are the seller, you can get assigned to sell your stock or buy the buyer's stock. And second thing is that you're going to be settling with the underlying asset, meaning that if you are selling a call, you will have to sell these shares at that strike price. And if you are selling a put, you would have to buy these shares at that strike price. Now, most of our crypto options, they work not in an American way, they work in the European way, and it makes them a little bit different. Of course, that doesn't mean that one is better than the other. Of course, there's always situations where an American type option is way better than an European type option and vice versa, but let's talk about the European type version. The main factor with the European crypto option is that you don't get assigned until expiration date. So the value of the asset can go up and down in price. You don't really care if it goes in or out of the money until the expiration date. Whatever matters for you, it's the price of the asset. This is difference number one. And difference number two is that at the end of the expiration date, you don't settle with the underlying asset. You settle all of it in SUSD, in this case for the protocol that I'm going to be showing, or maybe USDC or any other stablecoin when talking about European crypto options. So if you get assigned on your cover call, you won't have to sell your underlying asset. And same thing goes for the selling puts. You will only lose a portion of the collateral that you deposited, and that price values depending on how deep in the money the asset is. Of course, I'm going to be showing you examples of max profits and max losses here, but before we have to start to understand how these options work and how you choose the specific option for you to be profitable. So we're going to be jumping on Lyra or Lyra.finance. This is the protocol that right now I am using the most for my covered calls or cash covered puts. So I'm going to be showing you how does it work and how you can choose the best option for you to collect a very nice juicy premium. So let's jump right into Lyra. The link for it is going to be down here in the description, so make sure to check it out. It's going to be the second link in the description of the video, and you can see I already have a position right here so far, but right now we're going to be looking at a brand new option. So by clicking on trade, you're going to be seeing by default the daily chart for Ethereum. Right now it is trading at 1470, and if you scroll down a little bit, you're going to see two buttons, a buy and sell button and a call and put button. And over here you have a toggle down window with a bunch of different expiration dates. If you're familiar with the brokerage or Robinhood, you should be familiar with how this looks. It kind of looks similar. So I'm going to select sell put. You can also select sell call, it doesn't really matter, and the expiration by this week, so next Friday 29. And we have right here all these strikes. You can see if you go way in or out of the money, you won't have any liquidity anymore. So from 800 to 1200, you don't have how to interact with these options. You can see that some say buy only, so you can only buy them. And if you go down from 1900 to 2000, it is disabled as well. So if it goes way too far out or in the money, you're not going to be able to interact with these options. But let's select right here this option. The strike is at 1400, so $1,400. And let's take a look on what is showing us right now. What is saying, what is the information that we're seeing on our screen. So the first thing that we see, as we said before, is the strike. So this is the strike that we are betting on, and this is the break even. So the break even is the strike minus the price of the option itself, meaning that if by expiration date we are above this price right here, we are in the green, we are profitable. This is for puts. If it was for calls, if we need to be under the break even point for us to be profitable. Then right here we have the implied volatility. We're going to be talking a little bit more about them later on, and this is the actual price of the option. This is how much you're going to get by selling a full contract. which is what you're seeing up here. We're going to be talking about this in a little bit, but let's take a look right here where it says the Greeks. So what are the Greeks? We have to understand a little bit more before we jump back into the protocol itself. The Greeks are indicators. They are what moves the option in your favor or against you. So this is why you need to understand what is a Greek, how do they work, and each and every one of them, how do they affect the price of the option itself, because all of them, they affect directly or indirectly the price of the option itself. So we're going to be covering the 4 major Greeks right here. If we go back to the screen, you can see that we have delta, vega, gamma, theta, and rho. Rho for the strategy that we are doing, which is selling options, so not buying them, selling options. It does not affect us that much. So the majority of the time, everyone who is buying or selling options, they're not going to be looking at rho that much, because the majority of the time it won't change that much the price itself of the options. So we're going to be just talking about delta, gamma, vega, and theta. So the first one that we're going to be covering is delta, and delta has 2 main functionalities. The first thing that delta does is to show us how much the option price itself is going to change when the underlying asset, in our case Ethereum, changes by $1. So in our case, if Ethereum goes down $1, our option price is going to increase by this delta right here. So if we go back to our example, if Ethereum goes down by $1, so it goes to 14.69, our option price is going to go up by 33 cents. So you would have to get this number right here and add 0.33 to it, meaning that the option would go to $41.19, if I'm not mistaken. And another thing that delta is used for is as some sort of probability indicator if this option is going to expire in the money or not. So right here, right now, it has a 33% chance, more or less, to get in the money by expiration date. So delta is used for these 2 things. Now let's jump to gamma. Now gamma itself does not affect the price of the option, but it affects delta itself. So gamma shows you how much delta will change when the underlying asset changes by $1. So again, whenever the price of Ethereum changes up or down $1, not only the price of the asset will change because of delta, but delta itself will change because of gamma. So gamma calculates how much delta will change after the price changes. So let's go back right here to the example, meaning again, if Ethereum goes to 14.69, this one will go up to 41.19, and the new delta will be 0.333 plus 0.0018. So we're going to have a new delta, a new gamma, and a new option price itself, just because of that $1 move from Ethereum itself. So this is what gamma does. Gamma affects the price of delta, which again affects the price of the option when Ethereum goes up or down by $1. So now we have Vega. Vega in crypto options is very important to us because Vega moves with implied volatility. Vega affects the price of the option depending on how much implied volatility itself moves, if it goes up or down by 1. Right here, our Vega is going to affect by 0.52 the option price if implied volatility goes up or down by 1. So by each 1 point it goes up or down is going to affect in favor or against the price of the underlying asset itself. This is what in stock options is known as IV crush. If you are already familiar with stock options and you buy a call, but you buy at a very high volatility and then that volatility crashes down, even if the price of the stock itself goes up, because volatility went down, your option is going to be worth less. This is called IV crush. And this is very important for us in crypto. You can see that the volatility in crypto is way higher than you're used to in stocks, but they are always that high. We're looking at over 100% volatility for all these assets right here. The majority of them are over 100%, meaning that Vega has an important factor right here. And then we go back to Theta. You might have also heard about the Theta game if you are already familiar with options, but Theta is the seller's friend. Whoever sells options, they usually want a very high theta. The higher it is, the better it is for you as a seller. Theta is in favor of the seller and it is against the buyer every time. And theta is what is usually referred as play to earn. It is the decay that the option will lose each and every day. The closer it gets to expiration date, the higher the theta will be, the higher the decay will be on that option. And again, as I said, for a seller, the higher it is, the better it is for us. So let's take a look right here at our example. we can see our theta is 10.22, meaning that by each and every day that passes, even if Ethereum stays at the same price and volatility stays at the same price, this tomorrow will be worth $10 less. So it will be around $30.64, more or less. And of course, this is without counting how much Delta and Vega are going to go in favor or against the price itself as well. So you see how each and every day that passes, these Greeks right here are fighting against each other. Theta represents the time, Delta represents the asset itself, how much it is moving, Gamma represents how much Delta is moving, Vega represents the volatility itself, and you can see they are fighting 24/7 to establish the new price for the option itself. So let's say now you want to sell your options. How do you go about it? What are the things that you need to look for, and what are the things that you need to avoid? Now, I usually have a couple of parameters that I look at before selling any of these options. First of all is that if you are selling puts, you're going to be using the SUSD token, which is the USD stablecoin. And if you're selling calls, you need to have collateral. So you need to have the underlying asset, which is SETH, because otherwise you're going to have to use SUSD as collateral for you to sell these calls, but you will have to be over collateralized. So it won't be in your favor for you to be over collateralized for you to collect that premium. It's going to be a lower return on your investment. So what I usually look for are a couple of these things. I usually look for a delta between 0.25 and 0.45. This can be positive or negative depending if you're selling calls or puts, but it doesn't really matter if it has the minus before the number. I usually stay in between the 0.25 to 0.45 in delta. And another thing that I make sure to look for is a very high theta. Again, the closer it is to expiration date, and I'm doing weekly options, so the closer it is, the higher the theta will be for me. And this is good because I want my option to expire worthless. The closer to zero, if not zero, that it can get. So high theta, delta between 25 and 35. And another thing that I look at is at the chart to see if there is any support or resistance at that time, at that level, some sort of support or resistance that I can use in my favor. So let's take a look at these graphs right here, at the Ethereum graphs, so I can show you what I'm talking about. So we have right here my Ethereum chart. It might look a little bit messy for you, but this is what works for me. If you have your own methodology, if you are a Fibonacci user, if you are a moving average guy, a Bollinger guy, it doesn't really matter. You need to use what you know about technical analysis. And another thing is, don't use just one indicator because they're not bulletproof. No indicators are bulletproof. These indicators are not going to make you profit 100% of the time. But what I use are support and resistances. I use Bollinger Bands a lot, and I use a couple of moving averages. I use the 9 weighted moving average, the 20 weighted moving average, and the 50 weighted moving average. Right now we are at the 4-hour time frame. This green dotted line right here, this is the beginning and the end of the option that I sold. So this right here is the expiration date. This is my break-even point. So you can see that until this morning I was way out of the money, very, very safe, but Ethereum broke this little support right here. It broke through my moving averages, and it broke through this little support right here, and now it is free falling. If it goes below my break-even point, I'm gonna start to lose some money. But how much specifically am I gonna lose if it goes below? Again, this needs to close below by expiration date, so it needs to stay below this right here by the 29th. If by the 29th it climbs back up, then I am safe. I'm not gonna lose any money, and I'm gonna have the collateral and the premium that I got. Now let's run through a simulation. Let me actually show you, according to how I explained it to you, which options I would sell and how much would be our profit or losses, if any. So you can see right now, just as we were talking, the price of Ethereum itself got back up to 1505. So we're back to the 1500s, which is good for my put that I sold. But now let's take in consideration the factors that I told you about. We're going to sell puts expiring the 29th. We have our 1400 that I showed you before. We also have the 1500, but that has a very high delta already. So I'm going to discard that. We're not going to look at it, but let's look at that $1,400 once. So the break-even point is at $1,369. This is good for us because if we look at the chart again, 1369 is going to be all the way over here. So from the 1500 that we are right now, all the way right here, we're looking at an 8.5% drop, which is very, very far for us. The delta is good, is between 0.25 and 0.45. The theta is 9.38, really, really high. And we have our price right now. The price is at $30.24. Now we click right here and we will have this little window right here popping up. The size, if you leave it at 1, you need to deposit 1 Ethereum as collateral at that strike price. So $1,400 as collateral. A good thing about this is that you can fraction it. So you can use 0.05, let's say, which amounts to around $70 in collateral. So let's see what is the closest to $100. If we put 0.072, it amounts to around $100 in collateral. So let's say you deposit this collateral, you're okay with the Greeks right here, you're okay with the strike price, with the break even, you think this will go in your favor. How much would you collect in premium? What is your risk reward right here? Well, you're gonna deposit, leave in collateral $100, and you're gonna get in premium right now $2.17, meaning that you will have a return on your investment of 2.17%. This is weekly, really good, 2% per week. It is amazing. Now, the higher you go with the delta, the higher the premium will be. But again, the higher the risk you're running. But now let's look at the max profit and the max loss right here. What is your max loss? Well, your max loss is that $100 minus the premium that you collected. So the premium, you'll get to keep it. But the maximum that you can lose is $98.63, which is that $100 minus the $217 in premium that you get. But how low does the price of Ethereum has to go for you to lose that money? Well, if you see right here, once it goes below break even, so 1,369, you start to lose money. Let's say it goes all the way to $1,250. So around right here, you will lose $8.79 from that 100 that you had in collateral. If it closes in your favor, so it expires worthless or it expires out of the money, you get to keep the $2.17 and you get to keep the $100.80. And the lower it goes, the lower the price of Ethereum goes, the lower you can see right here, the red number going down, the more you will lose from that collateral. So this is what the difference is between European crypto options and the American stock option that we're used to. Of course, there's also European stock options, but they are also a little bit different. So you might think this is a bad risk reward for your money. Not really, because if we look at the delta, there's a 26% chance that this will go against you, meaning there's a 74% chance that it goes in your favor. I'd say a 2% return weekly on my investment, I'll get these odds any day, because if I can make 2% per week with these odds every week and I can keep compounding that, I'm going to be making over 150% APY per year. So this is really, really good, way better than selling options on stocks. On crypto, you have the possibility of making this in a very safe way. Now, if you're looking for 2 or maybe 3% ROI on options, on normal options, you're going to be looking at way higher delta than we're used to. So this is what I've been doing. This is how I sell my crypto here on Lyra Finance. Of other protocols are a little bit different, but the Greeks and how they work the same way across crypto options, stock options, they work the same way. So if you understand how they work, you can apply the concept across different protocols and brokerages as well. So what did you think about these crypto options? What did you think about this strategy by selling these options, collecting the premium, and doing that basically each week of the year? I want to hear your opinions. Make sure to comment down below. What did you think? If you want to learn more, if you want to understand more, make sure to also check the first link in the description, which is going to be the Sleep Money Club. Over there, we have an options channel. You can chat with us. You can talk about crypto options, stock options. We're always there to help you out. Also with other DeFi things, yield farming, everything crypto related. So I hope you guys enjoyed it. If you did, don't forget to like, subscribe, and turn on the notifications of this video so YouTube can recommend you the other videos that I'm going to post here in this channel. And again, thank you so much for watching, and I'll catch you guys in the next one. Peace out.